Hi, I'm Lisa Sarajian, Analytical Manager within S&P's Corporate Ratings Department. Welcome to Credit Matters TV. We recently updated our industry and economic outlook for North American REITs and real estate operating companies. Here to talk with me today about the key takeaways from that report is Director and Senior Analyst Beth Campbell. Beth, thanks for being here today.
Thanks, Lisa.
You note right up front in the report that the employment and consumer spending trends recently have been pretty choppy. Yet the outlook S&P maintains for the REIT sector is stable. Walk us through some of the supports for that stable view.
Certainly. Lisa, we focus on the macroeconomic factors predominantly that are associated with drivers for demand, tenant demand for space, and investor demand for commercial real estate. We also focus on factors related to new supply. Our view on the sector is supported by an expectation for moderate, continued gradual recovery in the U.S. economy. We expect modest growth in GDP and consumer spending trends to drive a slow, steady improvement in occupancy and rents for commercial real estate through 2013. And specifically, we're looking for GDP growth in our base case scenario of about 2% for this year and next year. We're looking for continued modest growth in consumer spending and sentiment. We also believe interest rates are going to remain low for an extended period, and that capital will therefore remain competitive and available for the REITs. We look for REITs to produce same-store NOI in kind of a 2 to 3% range this year, which is pretty consistent with last year's level. And also we're looking for, though, the apartment REITs to outperform. They've been showing some strength. We also expect office REITs to underperform, kind of around that relative to that 2 to 3% average growth rate. Under these assumptions, the financial risk profiles for REITs should remain stable to generally improve modestly.
Okay. Well, just continuing with that thought, if we do see some improvement in REIT financials, would that necessarily mean we'd be looking at positive rating momentum?
Not really. Our outlook overall is stable, and we don't envision that improved financials would alone be a driver for ratings upgrade momentum. And part of that is because we've already sort of baked in to our current ratings a forward-looking expectation for REITs to rebuild coverage measures that had eroded during the downturn. That being said, while our outlook on the sector is stable, and we expect most ratings to hold steady this year, we would expect potentially upgrades to outnumber downgrades, and that's really a driver of where we have outlooks now. 10 of 70 REITs carry positive outlooks currently, while only 2 carry negative outlooks.
Okay, but what are some of the risks facing this sector? Maybe you could speak to S&P's downside scenario.
Certainly. REIT credit quality weakens under our downside scenario, but really only modestly, and in part it's because of the long-term nature of the leases that generally provide cash flow stability for REITs. They've provided that in the past, and we believe will continue to provide cash flow stability through economic cycles. Even under our downside recession scenario, in which we see GDP slowing, consumer spending still remains positive, and therefore, it does provide some support for our sort of still stable, only slightly weaker outlook. Although we do acknowledge that, if job growth remains tepid and unemployment remains high, that will be a constraint on the consumer.
Let's shift back to industry supply-demand fundamentals. You note in the report that vacancy rates have been declining and that some of this is due to limited new supply. What do you think it's going to take to eventually spark new development?
Yeah, we really need to see rent growth before we see widespread new development, before that pencils out profitably. What we have seen is vacancy rate has been declining pretty modestly, and rents are starting to improve, but that improvement tends to lag the occupancy improvement. And also, really for only to date, we've seen apartment rents really recover to a point where development can pencil out. For the other sectors, we really expect, for office, industrial, and retail, just a more protracted recovery for rents. Therefore, we don't expect to see rent recovery as a driver for widespread new development in those sectors for a few years yet. Apartment development has accelerated, as we've talked about. The supply-demand fundamentals have been very attractive for the sector. Risk-adjusted returns are attractive relative to, for apartment REITs, relative to acquisition opportunities. What we're seeing is there's a lot of institutional demand for that product once it's stabilized, and therefore the acquisition market is really challenging. Prices have become quite steep, and returns for stable product is quite low now. So relative to that, for the REITs that we rate, who have development expertise, who perhaps have low basis land on their balance sheets, do have moderately leveraged balance sheets, we believe they're well positioned at this point in the cycle to pursue development.
Are we concerned at all about the potential for overbuilding in the multifamily space?
S&P is not concerned about apartment overbuilding, at least not for the next sort of 12 to 18 months. What we're seeing really is that the current level of expected deliveries is really returning to just a historical run rate average. We believe most markets can absorb the supply that's coming online. We also see that demand is expected to remain strong for that cycle. Longer term, we believe new supply, what it could do is constrain rental rate growth. For this year and into next year, we're expecting apartment rent growth in kind of the high single-digit area. But once this new supply starts to come online, we think that that growth level will moderate to more like a mid-single-digit level. Maybe a couple other things to talk about in terms of apartment development. We see little risk of competition at this point from the conversion of single-family homes to rental product. Some of that is sort of geographic driven, meaning a lot of that single-family product is in suburban locations, whereas most of our rated REITs, the REITs that we rate, their portfolios are concentrated in urban areas. So we think there's very little maybe direct competition there. That being said, however, one potential longer-term risk possibly for apartments is the likelihood of maybe a product mismatch longer term. The development that's underway now tends to be luxury product, higher price point, expecting a higher income tenant, whereas demand growth is really coming from the lower income end of the spectrum.
So the U.S. REIT sector in general, at least for now, is it safe to say it's sort of steady as she goes?
Yes.
Okay, great. Thanks, Beth.
Thank you.
And thank you for joining us today. For Standard & Poor's Credit Matters TV, that's it for now.